Thanks to trillions in central bank liquidity, stock markets are extremely bullish. Sentiment may be at record levels, and I'm going to show some of these stories that point this out. But the Dow made 71 new record highs last year. It went over 5,000 points, a record in one single year. Went from 19,000 to basically 25,000. Well, almost 25,000 in 1 year. I believe it hit 25,000 shortly after 2018 started. And a lot of other stock markets are also up. I think the S&P 500 was up 19%. This story here on Zero Hedge, the Swiss National Bank, which ran a Euro peg and created tons of extra currency units to become a hedge fund out of thin air, made $55 billion in trading profits last year, more than Apple, JP Morgan, and Berkshire Hathaway. and you think this is fundamentally driven? So basically, since the 2008 financial crisis, central banks, whether it's the Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England, the People's Bank of China, the Swiss National Bank here, those are pretty much the largest 6 or 7 central banks in the entire world, at least from one country, not counting the Bank of International Settlements. But those central banks have stepped into markets and started intervening in markets and, made trades. The Bank of Japan has huge Japanese stock ETF positions, and that's basically put a bottom in their stock market and started moving it higher. A lot of these central banks have been monetizing the bond markets. Now in Europe, European junk debt has a lower risk rating, lower yield than US Treasuries, which is ridiculous considering the probability of bankruptcy for most of the companies issuing junk bonds, how it's like basically a hot potato when you trade junk bonds, and it's a question of when and not if a lot of those companies will go bankrupt. And so basically now central bankers have distorted the stock markets and made them with, the Greenspan put, with the Bernanke put, with the Yellen put, with the Draghi put. Jerome Powell will probably, considering some of his comments that have come out in the Fed transcripts, if there is a huge crash in asset prices, he will probably not allow a crash for more than 6 to 12 months without even further intervention, because governments need the tax revenues from capital gains for asset prices, and they call this the wealth effect, and it's the wealth effect's BS. I've said this many times. There's a bunch of reasons why the wealth effect is occurring, but one of the main reasons the wealth effect was done was because during the 2008 financial crisis, U.S. tax revenues on capital gains and asset prices dropped a lot, and that's a big no-no. The government's already worried about tax revenues declining. So basically, here's a few other current events that are showing that whether it's at the retail level, whether it's at the institutional or hedge fund level, so retail and professionals are extremely, extremely bullish on general stocks right now. So the probability now, because of all this central bank intervention in the market sentiment, we could have the stock market, the Dow, go over 40,000 in a couple years, but I don't think it would be fundamentally driven at all. I think it would be just, euphoria, momentum, maybe further central bank intervention, because there's a lot of credit that's still leaking out of China and other countries that have been doing massive amounts of money and credit injections into their economy. So there's been a lot of money that's leaked out into asset markets all over the globe. And we have, record amounts of margin debt. The margin debt, I showed a chart in the Wall Street for Main Street Facebook group that was sent to me by hedge fund manager Kevin Duffy of Bearing Asset Management. And the chart for margin debt has gone parabolic. And there hasn't been a 3% stock market correction on the Dow or the S&P in well over a year. And so here's some of the other stories. Risk appetite indicator hits all-time highs. World stocks have longest ever streak without 5% correction. Wow. Top 20 number of trading days without a 5% pullback since 1928. So we're almost to the all-time high. Only about another month, and it'll be the longest ever. Morgan Stanley. People have a hard time even imagining how the market could decline. And this shows the VIX. Obviously, we know the VIX is manipulated, though, with the leveraged short volatility trade. So a lot of people have hopped on that as well. But that started with, the central bankers buying up asset prices. And then that's the piggyback trade with the leveraged volatility trade that a lot of Wall Street and retail traders have hopped on. Global stocks are the most overbought since right before 1987 bloodbath. So, in conclusion here, today's McAlvany weekly commentary. Melt up euphoria, no end in sight. Stock traders are 95% bullish. So he was talking about all the sentiment levels, low levels of portfolio managers, professionals holding cash. because there's career risk. A lot of people are not holding cash in anticipation, because one of the ways to hedge a stock market crash is to also have cash. Besides, shorting stocks or puts, is to also hold cash. And cash levels are also at a record low. So basically now, with all these central banker distortions, and humans are emotional creatures. The two strongest emotions are fear and greed. And right now in cryptocurrencies, and especially the stock market, greed are in control. And so people don't really have any fear, especially, with record low amounts of cash, record high amounts of margin debt, and record low amounts of people who are bearish on the stock market. Stock traders are 95% bullish according to surveys here talked about in the McAlvany Weekly Commentary. So the probability is that we could have the stock markets go a lot higher, but not on any fundamentals. This would be purely on momentum. I could see Dow 40,000. There's probably a high probability of that, but it's not on fundamentals. And I could also see a high probability then too in the next couple years, in addition to the stock markets going that higher, is also the stock market crashing. So I think we should thank central bankers for all these market distortions, and market participants are just acting really stupid thanks to central bankers.